So we are now on the week 8 in your LMS. So we are going to discuss now the allowable deductions, the first part. So here we are going to discuss the itemized deductions or the itemized allowable deductions to our to the gross taxable income, because we have our standard, we have our methods or ways on how these allowable deductions can be deducted to the gross taxable income. So we're going to discuss the first part of the itemized deductions. So our learning objectives here is to identify the allowable deductions of the individual and the corporate taxpayers, and to distinguish the itemized business expense and optimal standard deductions. Of course, what are those allowable deductions for the individual and corporate taxpayers? So the allowable deductions, these are the items of deductions that can be deducted to our gross taxable income. And these allowable deductions are the group of expenses that can be deducted to our gross income or the gross taxable income allowed by the BIR under the National Internal Revenue Code or the revenue regulations issued by the Secretary of Finance, okay? Because there are some expenses which are not allowed to deduct to the gross income, okay? So if there are some expenses which are not allowed by the BIR for the allowable deductions to the gross taxable income, so it may not be included. That's why in the National Internal Revenue Code, there have an itemized group of expenses that can be allowable deductions to the gross taxable income. Okay, so this is the matrix of the allowable deductions from the gross taxable income. So we have the ordinary deduction and the special deductions. In the ordinary deduction, the taxpayer must choose between the two. And these two are already tackled in our previous session, especially in the tax on corporations, because in the allowable deductions of the from the gross taxable income are the itemized deduction and the optional standard deduction. In the optional standard deduction, the taxpayer, if the taxpayer choose the optional standard deduction, then they will only compute for the 40% of gross income for the corporation or the 40% of the gross sales or receipt of the individual taxpayers. If the taxpayer choose the itemized deductions, these are the list of the deductions that can be specified in the computation of net taxable income. And what are those itemized deductions? Business expenses, interest expenses, taxes, losses, bad debts expense, depreciation and depletion, charitable contributions, research and development costs, and even the pension trust. While on the, so those are the ordinary deduction, and there's also a special deduction that can be deducted from the gross taxable income. And what are those? Health hospitalization insurance premium. We already tackled in the previous session that the HHIP can be deductible if this HHIP, if the taxpayer is earning 150,000 below annually. But if the individual or an owner of the business, what do you call this, earn 150,000 above in a year, then HIP is not subject for allowable deductions. And please take note that special deductions are allowed only to the insurance companies, if the business is insurance companies, mutual insurance companies, and even mutual marine companies. So going back to the ordinary deduction in the itemized, this is the highlight of our topic for today, which is the first part of the itemized deduction. We are going to discuss the first part of the itemized deduction, which is the business expense, interest, taxes, losses, and the bad debts expense. Okay, so let's have the following illustration here. Okay, so Mr. Juan de la Cruz a mixed income earner married with 3 qualified dependents and has the following data for the current taxable year. They have the annual salary, the allowances received from the employer, the gross sales from the business, the cost sales, and even the itemized business allowable expenses with a total of 435,000. Therefore, so the requirement is to determine the net taxable income using the optional standard deduction. So we are going to compute for the net taxable income of Mr. Juan de la Cruz and using the optional standard deduction as allowable deduction. Even though there is an itemized business expenses, but the instruction is to compute the net taxable income using the optional standard deduction. So here are the answer. So the net taxable income of Mr. Juan de la Cruz is 1,884,000 under the old regulation or the RA 8424. How does the 1,844,000 derive? So of course, they have to itemize or to summarize the gross taxable income. Since the income of Mr. Juan de la Cruz is a mix, then let us summarize the compensation income first. And what is the compensation income of Mr. Juan de la Cruz? The annual salary of 1,225,000 and the allowances received from the employer 144,000. So the gross compensation income is 1,369,000. And of course, the next one is to itemize the business income. So based on the data, how do we itemize the business income? Of course, the gross sale from the business, which is the 3,125,000 and less the cost of sales of 1,275,000. So the gross profit is 1,850,000. Okay, so therefore that is the business income. Okay, it's 1,850,000. So the total income of Mr. Juan de la Cruz with the mix of the compensation and the business, that is 3,219,000. And less the allowable deduction using the optional standard deduction, which is the 40% of the gross income from the business. Okay, do not be confused because in our previous discussion, the OSD is applied to the gross income on the business, not on the individuals. So you cannot combine the compensation and the business income. Only the gross sale from the business, which is the 3,125,000 times 40%, that's 1,250,000. So that will be the optional standard deduction. Okay, for the allowable deductions for Mr. Juan de la Cruz. And also the personal exemptions. Please take note, and I just want to clarify, under the train law RA 10963, that personal exemptions are not applicable anymore, but for education purposes, and it is a part of the module where this is a Republic Act or RA 8424, we can still use it as an application of educational purposes. So we include the personal exemptions. Okay, so for the basic personal exemptions, that's of Mr. Juan de la Cruz as individual, 50,000, and the qualified defendants as additional exemption of 3 times 25,000, so that's 75,000. Of course, HHIP is not, as you can see, in the HHIP, the required income is 150,000 below in a year, and Mr. Juan de la Cruz earns more than 150,000 pesos in a year. So there will be no HHIP. So that will be the allowable deduction and personal exemption. So the net taxable income is 1,844,000, and the allowable deductions of Mr. Juan de la Cruz, take note, deductions using the OSD or the optional standard deduction is 1,250,000. Even though there is an itemized business expense of 435,000, since we are looking for the allowable deductions and net taxable income using the OSD. Okay, so that is the answer to the illustration. Okay, so let us proceed now to the itemized deductions. Okay, so the itemized deductions, these are the itemized expenses or the group of expenses which allowable deductions to the gross taxable income, which is allowed by the National Internal Revenue Code of the BIR. Okay? And these itemized deductions are specific expenses, excuse me, which appear in the income statement of the business. And let us proceed now to the first part. As I've said, what are those itemized deductions that can be discussed on the first part? First is the business expenses. The business expenses, these are the ordinary, necessary, and reasonable expenses, okay, incurred in the running the operation of the business. Okay, and what are those business expenses that can be allowable deductions during the taxable year? Of course, the salaries, wages, and other forms of compensation. Please take note, this is on the part of the business expense because the salaries, wage, and compensation, this is the income of individual. But on the part of the business, this is a business expense. So do not be confused. And then even though, and part of the business expense is the gross up monetary value of the fringe benefits granted by the employer to the employee. So again, do not be confused. The fringe benefit tax is subject and is a final tax on the individual, particular in the managerial employee. But the gross up monetary value of fringe benefit on the part of the business, this is an expense. Okay? And also the travel allowance, expenses in the pursuit of the trade, business, or profession. This is also a business expense. Representation, entertainment, amusement, and recreation expenses, which is related to the development of the taxpayer's trade, business, or profession. It can be a business expense. The rental expense, commissions paid to the employees, supplies used, advertising and other selling expenses, and other similar business expenses. Okay, so let's have our illustration here. So during the taxable year, the total net amount paid for the salaries and wages amounted to 5 million after the following deductions. And what are the other expenses? Of course, the SSS employee contribution, Pag-ibig employee contribution, SSS, Pag-ibig employee contribution, the PhilHealth employees contribution, withholding tax, and in addition, of course, the company provides its manager a 255,000 cash as the fringe benefits. So the requirement is to compute for the allowable deductions for salary disbursement for the business or to the gross taxable income. Okay, so the answer that all given data on the illustration are the itemized business expense. So these are allowable deductions. And do not confuse again. Let us itemize the salaries and wages. Yes, that is an income of individuals. But we are talking about business expense. So on the part of the company, these salaries and wages are the expense of the company in the as a payment for the service of their employees. Okay? So and even the mandatory the statutory benefit of the employees as the part of the business expense, such as the SSS employees contribution 425,500, Pag-ibig employees contribution 130,300, PhilHealth employees contribution 73,400, and even the fringe benefit given to the employee 255,000. So the allowable deduction for the salary disbursement as the business expense to be deducted to the gross taxable income is 5,884,200. Okay, so another illustration again on the business or on the allowable deductions as the business expense. So during the taxable year, ABC Company incurred the following expenses related to the travel to its officers and employees. So what are those travel expenses? The foreign travel of officers and employees for attending the business seminars, that's 1.8 million. The domestic travel of officers and employees related to business, that's 900,000. and the travel expense of the spouse of the vice president for the administration, 272,000. So the requirement, compute for the allowable deduction for the travel expense. So let us itemize again. So we're going to itemize the inclusion of the travel expense as the business expense. Okay, the foreign travel of officers and employees for attending business seminars. Yes, this is inclusion as allowable deduction. What about the domestic travel of officers and employees related to business? Yes, this is also inclusions to the allowable deductions of business expense. But what about the travel expense of the spouse of the vice president for administration? It is not inclusions for the allowable deductions. Why? Because the travel expense of the spouse of the vice president for administration is not for business purpose. It may be a fringe benefit of the vice president that can be availed for her spouse. Okay, so this is not a business expense. So therefore, only that the foreign travel expense of the officers and employees and for the business and even the domestic travel of officers and employees related to business are inclusions as the itemized deduction. So the total allowable deductions for travel expenses is 2.7 million. Okay, so that is the itemized deduction, one of the itemized deduction for to the gross taxable income, which is the business expense. The second one, okay, the second one is interest expense. Okay, so the interest expense is also itemized deduction to the gross taxable income. Interest expense arise when a business borrowed money to a financial institution with the corresponding interest, and that is the interest expense. And even the penalty, excuse me, even the the penalty paid by the business due to delinquency of the amortization, this is also an interest expense. The interest expense can be deductible if there is an indebtedness must be in writing. Yes. The second one, that interest expense is deductible if the indebtedness must be that of the taxpayer. So it must be in writing, and this interest expense is for the taxpayer. Because if you are paying interest expense not for the taxpayer in the business, then it will not be deductible. The third one is the indebtedness must be connected with the taxpayer's trade, business, or profession, of course, because if the interest expense is not connected to the business of the taxpayer, then it will not be deducted. And the interest must have been paid or accrued during the taxable year. So it means that the interest must have been paid, or it should be paid, or it can be accrued during the taxable year. Okay, so what about the deductibility of interest expense? So in case that if the taxpayer has the following interest income earned, then the interest expense shall be reduced to the amount equivalent to the interest income, which is multiplied by 33%. And then in order to be this interest expense must be deductible in case that the taxpayer has also the interest income. So how do we compute? So to compute for the allowable deduction for the interest expense, of course, the interest expense less the applicable amount of the interest income. Okay, so the applicable amount of the interest income is the gross interest income multiplied by 30%. So it should be deducted to the interest expense in order to compute for the allowable deduction for the interest expense. Okay, so the next is, yes, how can the interest expense can be deductible if the interest expense can be deducted in full amount? Okay, so these are the following interest expense that can be deductible in full amount. And what are those? The interest for tax delinquency. Yes, it should be deducted. And the interest payment on the scrip dividends or the promissory notes issued by the corporation, interest payment on deposits, and interest payment on the bonds. So those are the deductible interest expense in full amount. And please take note that there are also interest expense which are non-deductible or not deductible to the gross taxable income. This is under the National Internal Revenue Code. So what are those non-deductible interest expense to the gross taxable income? Of course, if the interest paid in advance by the taxpayer using the cash basis method of accounting, because there are some interest are paid in advance to borrow the full whole amount of the proceeds. So this is non-deductible interest expense to the taxable income. Interest expense arising between related taxpayers. Okay. Interest expense if the indebtedness is incurred to finance a petroleum exploration. Or if you're granting a loan to finance a petroleum exploration, then this interest expense is non-deductible to the gross taxable income. Even the interest on the preferred stock, this is non-deductible. Interest agreed orally, and the interest on indebtedness that has been prescribed. So those are the non-deductible interest expense. So it means these portions are the itemized interest expense which are not subject as allowable deductions to the gross taxable income. The third itemized deduction is the taxes. Okay, these taxes are the other taxes paid by the business as part of their expenses. So we have the following requisites or conditions or requirements on when these taxes can be deductible or can be allowable deductions to the gross taxable income. First, the taxes must be paid or incurred during the taxable year. These taxes are connected with the taxpayer's trade, business, or profession, and these taxes must be directly imposed upon the taxpayer. Okay, so this is the matrix of the taxes which is deductible and non-deductible. Okay, so what are those taxes which are non-deductible? Okay, so the taxes which are non-deductible to the gross taxable income, of course, the Philippine income tax. If we talk about Philippine income tax, the income tax return. Of course, this is not allowable deductions to the gross taxable income. This is what we are getting for, or computing for, or paying for. Of course, this is not deductible. The estate tax, the donor's tax are also not deductible to the gross taxable income because estate and donor's tax are a form of a transfer tax. Value-added tax is also not deductible because this is indirect tax, that the tax burden can be transferred to other taxpayers. Even the special assessment, the stock transaction tax, and even the income taxes paid in the foreign country, which is treated as the tax credit or withholding tax. So those are non-deductible. Okay, but on the other side, there are taxes which are allowable deductions to the gross taxable income. And what are those? The import duties, or this is under the BOC. Excise taxes, occupation taxes, documentary stamp taxes, privilege and license taxes. Of course, these are local other taxes. Doc stamps is in the BIR. Privilege and license are the PPLO, of the local government, or for the automobile, we have the LTFRB, business tax, except taxes on the sale of shares of stock to the local stock exchange, and also the VAT. So they are talking about percentage tax, okay, in the business tax is to be deductible. And even the local business and municipal taxes, these are the real property tax, community tax, okay, which can be deductible to the gross taxable income, and even the automobile registration fee or the driver's license. Okay, this is also allowable deduction as the taxes that these are the allowable deduction as tax expense to the gross taxable income. Okay, please take note that the taxes has also limitation as a deduction or allowable deduction to the gross taxable income. For the non-resident alien engaged in trading business, and for the resident foreign corporation and also the resident alien, the tax deduction is only allowed for those classification taxpayers, taxpayers rather, is limited only to the income derived within the Philippines. Okay, so how do we compute for the deductible foreign taxes? So for the deductible foreign taxes, of course, they have to compute for the net income within the Philippines divided by the net income within and outside the Philippines, multiplied by the tax paid to the foreign country. Okay, so let's have the following illustration here. So the illustration here, the resident alien has the following income information. Okay, so what are those? The gross income in the Philippines, the gross income in Germany, business expense in the Philippines, business expense in Germany, income tax paid in the Philippines, income tax paid in the Germany. Okay, so those are the excuse me, the informations. So the requirement is to compute for the allowable tax deduction. So we are only computing the allowable tax deduction to the gross taxable income. So of course, for the non-resident alien engaged in trading business, foreign domestic corporation and resident alien, we have to compute or use the following formula. So the net income in the Philippines, of course, let us add this is the summary of the computation of the net income. So in the Philippines, 6 million. In Germany, that's 2 million. And the total net income with, of the Philippines in Germany, that's 8 million. So we have to compute for the allowable tax deduction. So of course, the net income, the income within the Philippines, 6 million divided by the net income within and outside the Philippines, that's 8 million. And then we multiply on the tax, the foreign tax paid. Okay, the foreign tax paid, so which is the 900,000. So the allowable foreign tax deduction here in the Philippines is 675,000. So this is the allowable tax deduction to the gross taxable income of the taxpayer in the Philippines. Okay, the fourth one, the fourth itemized deduction are the losses. Losses is also a deductible to the gross taxable income. These are the damages arise from the fire, storm, shipwreck, casualties, robbery, theft, or embezzlement. So the following losses have the requirements on when these are deductible. The loss must be actually sustained in a closed and completed transaction. And the second one, the loss must be on the taxpayer, and the losses are incurred in connection with a trade, business, or profession. Because if there are some losses which are not related to the business, then it will not be treated as allowable deduction. And the third one, the loss must not be compensated by the insurance or other forms of indemnity. Okay, so that is also can be declared. And the loss must be reported to the BIR within the period of 1 month to 3 months or 30 days up to the 90 days from the date of discovery of the loss. Okay, so this is the matrix of the classification of losses. So in the losses, we have the non-deductible losses and deductible losses. So the non-deductible losses, these are the all losses which do not meet the requisites or the requirements that cannot be an itemized deduction. And what are those deductible losses? So the deductible losses is composed of 5 or 4. And what are those allowable deductible losses? The business losses, the casualty losses, the net operating loss carryover or the NOLCO, the losses from the theft, robbery, or embezzlement. So how much is the deduction of those losses? If the deductible loss is a total loss or the whole loss, we must compute for the book value of the loss asset less the insurance, if any. If the loss is only partial, we can get the value of the book value or the of the loss asset or the replacement value, whichever is higher, then less the insurance. Okay, if any, and that will be deductible loss. Okay, so let's discuss about the deductible losses, business losses. The business losses, those are the unpaid debts extended to customers. So how can we sum up the business losses? So the unpaid debts plus the interest, that is the total business losses as allowable deductions. So what are the requisites rather in order that the business losses can be deductible? So if the taxpayer report income is using the accrual basis on the business losses, then that will be deductible. But if the taxpayer reports that the income using the cash basis on the business losses, excuse me, these are not deductible, or this is not allowable deduction. Okay, so let's have the illustration here. Mr. Juan de la Cruz owns a 15-door, a 5-story commercial building with a monthly rental of 10,000 pesos. At the end of the current year, the tenant occupied the 5th door has not paid its rental fee for the 6 months. Excuse me. So that is the deductible loss or business loss. So let us compute for deductible loss if the taxpayer is using the accrual basis method of accounting, and compute for the tax deductible loss if the taxpayer is using the cash basis method of accounting. So as per our regulation, of course, the accrual basis, that will be allowable deduction. So 10,000 monthly times 6 months, that is 60,000. So that will be the itemized allowable deduction as business loss. But on the cash basis, there is none. Okay, there is none because as per our rule, if the taxpayer using the cash basis method of the losses, then it will not included as allowable deductions. Okay, the second classification of the losses is the casualty loss. By the casualty loss, those are the losses that arise from the accident, natural calamities, or man-made events in destruction and deprivation or deterioration of the property. And the casualty losses are also they have also the following requisites or requirements in order that these casualty losses are subject to allowable deductions. So first, there is an additional requisite. There's an additional requisite to be deductible, and the casualty losses should be on account of the following: fire, storms, flood, earthquakes, shipwrecks, and even car accidents. Okay, so let's have the following illustration here. Mr. Juan de Cruz owns and operates a printing business. During the taxable year, the business building and all its equipment were destroyed completely by the fire. So the following are the relevant data. So what are those relevant data? Excuse me, the cost of building, accumulated depreciation building, the cost of equipment, accumulated depreciation equipment, fire insurance on the building, that's 100,000, and of course, the requirement is to compute for the deductible loss. Okay, so how do we compute for the deductible loss? Of course, let us itemize. So first is the cost of the building. So this is the casualty losses, of course, because it suffers to the damage by the fire. So how can we compute for deductible loss? So the cost of building, 1,250,000, and less accumulated depreciation for the building, that's 350,000. So the deductible loss on the building is 800,000. And next is the deductible loss on the equipment. So the cost of equipment is 250,000, and less accumulated depreciation equipment, that is 70,000. So the book value, so the book value is 180,000. So since there will be no insurance, so the insurance is not allowable deduction. So the deductible loss for the equipment is 180,000. Then we must combine the deductible loss of the building and equipment, so with a total of 980,000. So that is the allowable deductions on the casualty losses. Okay. Another illustration, the following data were taken from the records of Mr. Ramil Santiago, whose business assets was partly destroyed by the fire. Okay, so this is another example that the loss is a partial loss, not the total loss. Okay, so what are those partial loss? The cost of the machinery and estimated useful life of 20 years. Accumulated depreciation as of the fire, that's 10 years. And the estimated cost to replace the damaged portion is the replacement, which is the 1.8 million. So let us compute for the deductible loss. Okay, so what are those deductible loss? So the cost of machinery, 3 million. Less accumulated depreciation for the machinery, that's 2 million. And the book value is 1 million. Then we must compare the book value to the estimated cost to replace. So as per our rule, whichever is higher. So the estimated cost to replace is higher than the book value, then the estimated cost to replace is the one to first to be deducted. Okay, less the insurance. So the deductible loss is 1.8 million. Okay, the fourth one. Okay, the fourth classification of losses is the net operating loss carryover, or the NOLCO. The net operating loss carryover is the allowable deductions over the gross taxable income in a particular taxable year. So it means these are the allowable deductions for the taxable income. Okay, and this NOLCO, it should be carried over as deduction from the gross income for the next 3 consecutive taxable years immediately following the year of such loss. So that is what do you call this? The net operating cost carryover. Okay. Okay, so based on the matrix, okay, there are some taxpayers which are entitled to deduct the NOLCO, and there are some taxpayers which are not deducted or non-deductible or non-deductible or not allowed or non-allowed deductions, okay, to deduct the NOLCO. And what are those allowable deductions? Okay, according to NOLCO, if the taxpayer is a self-employed and individual taxpayers, the estate and trust, okay, this is a net operating loss carryover that can be deducted. Domesticated and resident foreign incorporations, excuse me, covered by the normal corporate income tax. The domestic foreign corporation, subject to preferential rate like hospitals and private education. Okay, for the taxpayers who are not entitled to deduct the NOLCO or the net operating cost carryover. So the individual taxpayers are earning purely compensation income, so they are not allowed for the NOLCO. Offshore banking units, foreign currency, deposits units of both domesticated or domestic and foreign banks, and the taxpayers who are exempted by law from deduction. So those are the allowable deductions. So those are the non-deductible deductions. Okay. Okay, so let's have the following illustration here. Okay, so the records for the 5 years or for the past 5 years of XYZ Manufacturing Company show the following data. And what are those following data? So the gross taxable income and the allowable deductions from year 2013 and 2017. Okay, now let us compute or determine how to charge properly the operating loss of prior years for the succeeding years and the amount. So what they are asking here is how to charge properly the operating loss, okay, of prior years. So let us compute that. So we can get the net operating loss carryover costs. Okay. Okay, so here are the answers. So let's begin with the year 2013. Okay, so in 2013, of course, the net income is negative 350,000. So therefore, that is not subject to tax because it's a loss. So that will be the net loss of 350,000. And on the following year, the net income or the net loss of the previous year will be the net operating loss carryover to be deducted on the current year. Okay, so in 2014, the net taxable income is 100,000 and less the NOLCO of 350,000. So the net loss is still 250,000. In 2015, of course, the net taxable income is 2 million. And then the net operating loss carryover for 2014 is 250,000. So therefore, it will be deducted to your gross taxable income. So the net income or net loss is 50,000. And for year 2016, okay, so the 2015 net operating loss carryover should be deducted to 2016. So the net taxable income is 150,000 less the net operating losses carryover, which is 50,000. So therefore, the net income is 10,000. Okay, so it means this is the computation of the taxes. Okay. Oops. Okay, next is the losses of the theft, robbery, embezzlement. So from any amount of the losses are fully deductible, and it pertains capital losses and loss from the sale of shares of stock. Yes, that's the effect. So if you that's the effect, because if there are some losses, it may be deducted from the sale of the stock or even from your salary. That is the saddest thing. Of course, and the fifth one, okay, the fifth one of the itemized deduction is the bad debts expense. The bad debt expense, these are the uncollected amounts or uncollected receivables of the business to their clients, especially if these collectibles or receivables are uncollected within 1 year period. Okay, so because this bad debts expense, it will be treated as losses due to uncollected receivables or the incapability of the client or the customers to pay for the loan or to collect receivables by the business. So what are the requirements on when the bad debt should be deductible? First, there must be an existing debt, which is valid, subsisting, and demandable. The second one, the existing debts must be ascertained to be worthless. The third one, the debts must be charged off within the taxable year. When we say charge off, it can be paid, okay, during the taxable year. So there will be an what do you call this? The debts must be charged off with the taxable year. So it means that the debts must be deductible loss or deductible as to the gross taxable income because bad debt is uncollected receivable, so it will be treated as loss, especially in accounting. And the existing indebtedness must be connected with a trade, business, or exercise of profession, and the debts must not be sustained or incurred between the related parties. Okay, so we have the following illustration. Mr. Juan de la Cruz, married, a sole proprietor, was granted the following loans. He lent to the customers of the business 5 million, and he lent to his father 735,500. So during the year, it estimates revealed that 20% of the amounts lent to the customers could no longer be collected. Take note that 20% of the 5 million could no longer be collected. Then, however, customers with a debt amounting of 250,000 had been declared by the appropriate court bankrupt and such account to be worthless. And similarly, Mr. De La Cruz had only ascertained that the loan extended to his father would never be collected. So the requirement is to compute for the deductible bad debts of the taxpayer, which is what Mr. Juan de la Cruz. So the answer, of course, is the bad debts of 250,000. Okay, because of the uncollected receivable, which is the customer is declared as a bankrupt and they're incapable to pay the Mr. Juan de la Cruz anymore. So that will be a loss. So that will be the allowable deduction as bad debts expense. Okay, so that will be our topic for today. Okay, when it comes to the first part of the allowable deductions. Okay, this is the first part. So let us reiterate the first part as part of the itemized deduction. So these are the business expenses, the interest expense, taxes, losses, and the bad debts expense.